What's up, everyone? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to cover the two Canadian dividend stocks to buy in June. These are stocks that I own in my portfolio. I was buying them in late May, and they're still at very similar prices. So my money is always where my mouth is. I believe these stocks will double in the next 3 to 4 years and are very good long-term buy and hold stocks to just kind of set and forget. So we're going to cover SRU.un, that's Smart Centers Real Estate Investment Trust, as well as GWO, that's Great West Life. They're a life insurance company. So stay tuned as I deep dive on these stocks to show you why I think they're a great buy today. So let's discuss SRU.un. We can see here that normally it's a $30 stock or more, and it crashed to $15 in March. I was pretty tentative to buy it this time just because it was a little bit scary given their industry, but I've been buying a little bit at around $20 and now more recently at $19.50. I also was buying here at around $17.30 when I got up the guts to do so. We can also see that over the past 5 years, their price has been pretty flatlined, and I'll explain why that is in a minute, despite their growth. So taking a quick look at their revenues, we can see that they've been growing consistently over time, and also their gross margins have stayed pretty constant, which means their net income has been pretty solid as well. We are going to see some fluctuations in their net income depending on what type of investments they're doing as they build their company into the future. Because we're investing in dividend stocks, we want to take a look at the dividend history here, which of course has been pretty solid. $1.55 10 years ago up to $1.81. So not a lot of dividend growth, but it has been growing over the past 5 years. You can also look at their payout ratio, and this is calculated based on their net income, which can really vary depending on what's going on in the accounting world and what investments they're making. You know, a business can drop its net income to very low in a year to avoid taxes and reinvest in growth. And so what we actually want to look at is the free cash flow. And so the way that we calculate a payout ratio for ourselves, that really it gives us a bit more information on their ability to actually pay their dividend, is we take their free cash flow in the trailing 12 months here, $368 million, and then we go ahead and we look at the total number of outstanding shares and the dividend that they're paying on an annualized basis. And when we bring up our calculator here, it's a pretty simple calculation. I take the $1.82 and I times that by the 170 million shares outstanding, and then I just divide that by the free cash flow, and we can see their payout ratio based on their free cash flow is 84%. So coming back here, we can see they have a dividend yield of 9.5%, which I do believe they'll be able to pay. An 84% payout ratio on their cash flows is pretty standard for REITs. It's just because they tend to pay out a much higher percentage of their net income, and they do this because they get tax benefits. And remember, if you're investing in real estate investment trusts as a Canadian, make sure you're putting these in your RRSP or your TFSA, because they are not eligible dividends, meaning you will pay more tax on them than normal dividend income from other corporations. And so that's just a real estate investment trust note. Next, I'm going to use simply Wall Street to take a look at the insider holdings, and we can see here that their management team have fairly weak insider holdings, which isn't great. But when we scroll down to the board members, here's where we find our gold nugget, the man himself, Mitchell Goldhar. So Mitchell Goldhar owns $340 million worth of shares. And remember, that is the worth at the depleted value that we see today. So normally that's worth over $500 million. And we can also scroll down a little further and see the insider transactions. And our boy Mitchell has been buying up a storm here in March, 1.3 million, another 1.5 million earlier in March on the 11th, and another 976,000 on the 3rd. So this guy is going all in on his own business. He's reinvesting into his own business. And we love to see this because this is a billionaire who built his company from the ground up. You can Google him to find out more about him. But basically, when someone is putting all of their own cash back into their own business, this gives us a huge boost of confidence that this man is going to be making wise decisions over the long term because his net worth is tied directly to the business. We can also look to see if the book value per share has been growing over time, which it has been. And again, this is calculated on a per share basis, so I'll talk about that in a moment. But what's interesting to note is that the book value right now is $26.49, meaning that when you take their total assets minus their total liabilities, and if you sold everything today, that each share owned would be worth $26.49. So when you compare that to the current 1950, there's an obvious discrepancy there. Now, what you can get for assets if you had to liquidate is very different than what they're worth on paper, but this gives us a good idea that this business actually has a lot of strong assets that are worth a lot more than its stock price is telling us at the moment. And we can see that in the financial health here, as they have, when we compare their total assets to their total liabilities, they have about 10.5 billion in assets versus a total liability of 5 billion. Taking a closer look here, we can see they have 439 million in cash and short-term investments, as well as debt of 4.8 billion. Now, it's very common for real estate investment trusts to have high debt, and this is simply because they're buying and investing into huge projects. Imagine for yourself buying a house, you tend to put 10 or 20% down, and the rest is borrowed. And this works well because you're buying an asset that has stable value over time and is able to produce cash flows. Imagine if you were renting it out. So going back to the book value per share, we can see that it's been fairly flat over the last several years, and that's primarily because the number of outstanding shares has been growing. They've probably been issuing shares to raise money for projects or just reward executives, and what that does is it just has negative pressure on the book value, of course, because that's on a per share basis that we're looking at here, and also it has negative pressure, downward pressure on the share price itself, which helps to explain that despite growing revenues and profits, the stock has not grown substantially over the last 5 years. It's just a simple case of supply and demand. Now, of course, when we look over a longer timeline, we do see some share growth. It will happen. It just takes longer if the number of shares outstanding is creeping up. And again, these investments that they're making really play out over a much longer timeline. Imagine you're building an apartment building. It takes a serious amount of time, and then you start to recoup those costs over a period of 10, 15, 20 years. We can also take a look at the quarterly report that was recently released, and we have the Dream Team here, Batman and Robin, the Goldman, and Peter Ford. The Goldman, of course, is the executive of Charisma. Look at this guy's stare. He means business. And then we have our nice guy, our resident nice guy, Peter Ford, and they're giving us some good information on what is going on with the business during this time. So we can see that approximately 60% of their rental revenues are derived from retail tenants that are essential businesses that remain fully or partially open. Walmart is the anchor in 73% of their properties, representing 25% of their total rental income. And when we scroll down here, we can see that 92% of their business is unenclosed retail from, renters like Canadian Tire, Sobeys, Metro, Rexall, Home Depot, etc. So a lot of solid tenants, and they collected 72% of their rent in April. Obviously, that's not amazing since they're missing 28% of their rent, and some portion of that is going to be deferred into the future and paid later, and some portion of that may never be paid in terms of bankruptcies occurring. So this is where the question comes in, and this is where the risk comes in. Meanwhile, they are continuing with their major developments as their aim is to diversify their holdings away from just unenclosed malls, and they talk about the various apartment buildings and senior residences and self-storage buildings that they're building, largely in the greater Toronto area, but also one project here in Laval, Quebec. So they're diversifying, and I like that they're going into the Greater Toronto area, just because more and more people are flooding to these urban centers. Statistically speaking, those are the places that are going to grow the most, and so demand will rise for apartments. So I really like what they're doing there. And they also touch on their liquidity. And so what we're talking about here is their ability to withstand tough times. So they discuss their low levels of debt. Now, they have a lower level of debt than other REITs, which is fantastic. And we saw earlier that they have a very serious positive net asset position with $5.6 billion in unencumbered assets. These are assets that are debt-free and they can use them to borrow against. They also have the $440 million in cash plus an additional $250 million line of credit option. Okay guys, so let's take a look at Great-West Lifeco, but before we do, please smash the like button if you're getting value, and if you're enjoying this content, hit the subscribe button and ringy ding dong dandy those bells. I really appreciate the support guys, so thank you so much for tuning in. All right, so let's carry on. Great-West Life is a insurance company, a life insurance company run by Paul Mahone, who has been with the company for 27 years. And it has been smashed just like everybody else in March, but really hasn't recovered. And so that's part of why their dividend yield is so high right now at 8.37%. So let's take a closer look. So first of all, we can just see their 10-year dividend history here. And we see that they've been paying a solid dividend and have been raising it over the last 5 years. And when we take a look at the historical payout ratio, we can see that they've been living in that kind of 50 to 60% range, although it's spiked up a little more to 76% recently based on their net income. Now, if we're to use their free cash flow, which is another way of looking at their payout ratio, and I like to use that one as well, it's actually about 25% right now when I did the math. So they can easily afford their dividend, in my opinion. And this is a company that isn't necessarily growing by leaps and bounds recently, so they're not necessarily needing a ton of cash for ongoing growth. So checking the insider holdings, we can see that the CEO has $3.3 million worth, which again normally is worth about 30% more, and that's okay. But his compensation is $7.6 million a year, and nobody else in the leadership team really has too much invested in the company. So that's a little bit of a warning sign. But let's take a look at the directors. Okay, so we scroll down to the directors here, and we can see that Andre Desmarais, which I'm probably butchering that name, has a stake of worth $7.5 million, so fairly substantial. So that's a fairly good sign. He's been on the board for 28 years, and I want to explore this just a little further. So when we scroll down further, we can look at the top shareholders, and we can see that the main shareholder in this business is Power Financial Corp, which is just another Canadian corporation, and the Desmarais family residuary trust also has a huge stake in the business. So since Power Corp owns most of Great-West Life, I want to take a look at who is behind Power Corp. And we can see here that the CEO and president, Robert Orr, owns 10.4 million of Power Corp, which is pretty strong insider holdings. We see Andre here again with a holding of 32.5 million, which again, a huge stake, and then some other guys with some, shares here and there. And if we scroll down a little bit further, we can see here that the family trust owns 15% of Power Corp. So this family owns a huge chunk, basically, of Great-West Life. So with a quick Google, we can see that Paul Sr. was the one who started this business and has an estimated family net worth of $4.5 billion US, and he died in October 2013. With a little further Googling, we can see that it's the two brothers, the sons of Paul, who have been running the business, and they've been doing a fairly good job, but they recently stepped down. This article is from 2019, and they were overhauling their business, and so now they're just sitting on the board instead of being the CEOs. So going back to Great-West Life, essentially they're owned by Power Financial Corp, and this family has a huge stake in Power Corp as well. So, when we're looking at second generation owners, it's not always a great thing. They've been leading the company for quite a while, and I think have done a pretty good job overall, although we'll take a closer look at that. I am glad to see them step down as CEOs. Generally speaking, second generation leaders aren't always as effective as the first generation, the father. So it is something where this is a positive in the sense that we have a huge stake. There are huge insider holdings in this company, but there's a little bit of an asterisk beside it there. So next, I'll take a quick revisit to the revenue, and we can see that it's been growing pretty consistently. Although, of course, when we look at the net income, there is some variance. Sometimes they're going to have larger claims in a certain year than other years. And companies like this, Great-West Life and other life insurance companies, they're taking a lot of the cash that they get from their business and then they're investing it into bonds and other investments, and how those investments pay off over the long term can affect their bottom line in a given year as well. Next, I like to look at this shares line, the outstanding shares, and we can see here that they've actually been buying back shares. So despite buying back shares, their share price hasn't risen drastically. I'll show you that here. We can see that over the past 5 years, it's been pretty flat, even with a slight downward trend in recent years. And that's probably just because Wall Street loves to see huge growth. Now, I know that a business generally over the long term has to grow, but it can go through phases like this where its revenue growth flatlines and it just focuses on efficiency, on raising dividends, on doing share buybacks and adding value in that way. Not every business has to grow every single year, and Wall Street investors tend to want to chase growth, so they don't like companies like this. But for me, this is a company that will easily be able to pay its dividend and over the long term will have solid growth. So I can pick it up at a price where the dividend's 8.5%, and then really capitalize over the long term. So Great-West Life recently reported their Q1 results, and like many other businesses, they've had some tough times with the COVID situation, and they come out here and they say that their net earnings per share was 37 cents per share as compared to 67 cents in the quarter in 2019. And then they talk about their base earnings for the first quarter was 59 cents per share versus 58 cents per share a year ago. And I'll explain a little bit more about that, but mostly we want to focus on their actual net earnings per share, which was down fairly substantially. So here in the quarterly report to shareholders, we can see their little chart of their Q1 and comparable Q1 in 2019 earnings. And we can see here that their net earnings were down significantly, although their base earnings were fairly simple. And now what they do here is they break out their losses that are kind of extraordinary given the circumstances. And so that's what they're calling their base earnings, which is like their normal course of business. And then they lost a fair bit of money just from the financial investments, less to do with any actual fundamental changes in their business, but they're invested in financial markets, primarily in bonds, treasuries, more safer investments like this. And they had to take a significant loss. And I'll explain that a little bit more in a minute. So there's so much to unpack in this shareholder report. I can't go through all of it with you, but I want to highlight a couple of key things. One of them is they basically say the impact of the pandemic on mortality is uncertain of this time. One of the reasons that I'm investing in this business now is because I think the impact on mortality is going to be fairly limited. When I put on my investor hat and remove the emotion from the situation, I think it's fairly clear to me that the government and the world is really going to do everything that it takes in order to limit the spread of the virus. And so I don't think it's actually going to be that big an impact on this type of business. So we can see here that part of their loss is from the actuarial assumption changes and management actions, which essentially means they had to adjust for the potential deaths that may occur and make sure that they have enough liquid cash available. And so they have internal rates of liquidity in their own business that they need to hit. And sometimes this forces them to sell assets at a loss just to make sure that they have the cash available in case it is needed. And also, this is pretty similar over here with the market-related impact. As I was reading through this, it was pretty convoluted as to exactly what this is, but all we really need to know is that this has less to do with any changes to their core business and a lot more to do with write-downs and losses in their investing side of the business. So now let's take a quick snapshot of their financial health. and we can just do this again. This is a 10,000 foot view, but it is fairly useful, where we just add up their total assets and their total liabilities and compare them, and they have total assets of 435 billion, roughly speaking, compared to total liabilities of 410 billion. So that's about a $25 billion surplus in terms of assets. Again, this is not necessarily the most scientific or analytical way to really look at things. It just gives us a really quick idea. And then we can see here that they have 102 billion in cash and short-term investments. So finally, I just want to cover a couple of things from Morningstar, and we can see here that they don't have an economic moat. And this is just because life insurance is a competitive business where the product is essentially a commodity, which is to say that everyone is offering the same thing. We can also see that Morningstar believes that Great-West Life is the best run of the three big Canadian life insurance companies, in part because they posted the highest returns on equity, averaging 13% over the last 5 years, which is absolutely phenomenal. Okay guys, so I just want to wrap up with a couple of important points, but first of all, hit the thumbs up button if you got value, and also drop me a comment. Let me know if you have a Canadian dividend stock that you've been buying in May, or what your thoughts are on these two businesses that I explored here. I love hearing from you guys, and thank you for the support. So quickly here, I just want to again frame this around the idea that personally I'm staying patient. Yes, I have that itchy part of my brain that wants to buy, so I feed it a little bit. You know, I bought at $19.50 the other day for SRU.un, about $600 or $700 worth, just a small amount relative to the position that I have, and mostly I'm sitting on the sidelines, staying patient. You know, we can look at legendary investors like Warren Buffett, and they have huge cash stockpiles right now, and that's kind of where I'm at as well. But again, what we don't know is always much greater than what we do know. We can't predict the future, so I think that these are offering some solid value at today's prices given the risk profile. So I hope you enjoyed the video. If you want to check out some more, you can check out my video on the top 3 Canadian dividends to buy and hold forever. These are a core of my portfolio and I think are very valuable to keep on your watch list. Okay, thanks so much for tuning in. Appreciate it, and we'll see you next time.